The markets are closed, the trading screens are dark, and the final silver price sits frozen, but behind the scenes, fear is quietly spreading through the financial system. While the public enjoys a holiday calm, emergency meetings are unfolding inside boardrooms and regulatory offices where the stability of global markets is openly questioned. A sudden 10% surge in silver is not normal volatility, because a move of that size in a core commodity threatens leverage structures built on fragile assumptions. When silver accelerates this quickly, it shatters bank risk models, destroys hedge fund margins, and places immense stress on the clearing system holding trades together. The clearinghouse stands at the center of the market, guaranteeing transactions and absorbing losses when participants fail to meet their obligations. If a major institution defaults on silver exposure, the clearinghouse must pay, and if it cannot, the entire market can freeze instantly. This is why emergency calls are being placed across continents, as regulators and banks scramble to prevent a cascading failure before markets reopen. These closed-door meetings are not signs of confidence, but unmistakable signals that control over price behavior is slipping away. Silver has exposed a weakness in a system built on extreme leverage, where borrowed money amplifies profits during calm periods and annihilates equity during shocks. Many institutions operate with leverage ratios so high that even modest price movements can erase their capital entirely. A 10% adverse move is enough to push heavily leveraged short positions into instant insolvency, leaving obligations unpaid and losses spreading outward. Normally, margin calls would force weak players out, but the problem becomes systemic when the failing entity is too large to liquidate safely. When liquidation risks crashing the entire market, the response shifts from enforcement to negotiation and emergency intervention. History shows that when markets reach this stage, rules are often rewritten to contain losses rather than allow full price discovery. Similar weekend meetings preceded past financial crises, where authorities acted to prevent disorderly collapses at the expense of market credibility. Today, silver has once again become the pressure point, revealing how fragile leverage systems truly are. The speed of the price move matters more than the price level, because rapid acceleration overwhelms risk controls designed for stable conditions. As Sunday approaches, uncertainty dominates, because no participant knows what rules may change before the opening bell. Thin liquidity and fear of exposure create conditions where prices can gap violently in either direction. This moment marks the beginning of a confrontation between physical reality and financial engineering, with silver standing at the center of the storm. To understand why silver triggered this reaction, you must understand leverage, because banks rarely trade commodities with their own capital. Instead, they borrow aggressively, using leverage ratios that magnify small gains into large profits during quiet markets. This structure appears stable until volatility returns, when leverage transforms from a profit engine into a weapon of destruction. A 5% adverse move can erase all equity for a 20-to-1 leverage position, leaving nothing but unpaid liabilities. Silver's sudden 10% rise instantly pushed many short positions beyond recovery, creating losses that cannot be patched with time. These losses do not stay isolated, because obligations spread through counterparties linked by contracts and guarantees. When one participant fails, others must absorb the shock, even if they managed risk responsibly. This is how localized stress becomes systemic danger inside tightly interconnected markets. In normal conditions, banks issue margin calls and liquidate losing positions without mercy. But when the losing position belongs to a massive institution or sovereign entity, liquidation becomes politically and financially impossible. Forced liquidation of a giant player would crash prices violently, damaging innocent participants and destroying liquidity. Faced with this dilemma, regulators and banks seek alternative solutions behind closed doors. These discussions revolve around containment rather than fairness, prioritizing system survival over transparent price discovery. Emergency playbooks often include rule adjustments, trading halts, and margin requirement changes. Such measures aim to slow price movement long enough for institutions to regain footing. However, these interventions often signal weakness rather than strength to experienced market participants. Traders understand that if rules must change, the existing structure is already failing. Silver's behavior suggests that leverage has reached a breaking point across multiple layers of the market. As confidence erodes, fear replaces rational positioning, amplifying volatility instead of suppressing it. This feedback loop ensures that once panic begins, it becomes increasingly difficult to contain. As the crisis deepens, attention turns to the clearing infrastructure that quietly supports every trade executed across global commodity markets. Clearinghouses act as financial shock absorbers, stepping in when counterparties fail to meet obligations. Their default funds are designed for ordinary stress, not extreme dislocations driven by leveraged short squeezes. When silver prices surge rapidly, the notional value of short positions explodes beyond historical assumptions. Losses can quickly exceed the size of default funds built during calmer eras of market stability. If that fund drains completely, trust in the exchange itself begins to fracture. Once trust disappears, liquidity evaporates, and trading activity collapses almost instantly. To prevent this outcome, exchanges are granted emergency powers rarely used in normal markets. These powers include trading halts, margin hikes, and forced liquidation-only conditions. Each intervention is intended to slow momentum, but each also damages market credibility. Participants begin questioning whether prices are real or administratively controlled. This uncertainty discourages voluntary sellers, shrinking supply even further. When sellers withdraw, price gaps become larger and more violent. What begins as a defensive action can unintentionally accelerate the very move it aims to stop. Clearing risk therefore transforms from a technical issue into a psychological one. Fear of settlement failure becomes more powerful than fear of price volatility. In this environment, even well-capitalized players hesitate to provide liquidity. The result is a fragile market balanced on confidence rather than fundamentals. Silver's rapid ascent exposes how dependent modern trading is on uninterrupted trust. When that trust wavers, the system reveals its true vulnerability. As clearing risk intensifies, pressure spreads outward into collateral markets that underpin daily funding across the global banking system. Banks rely on government bonds as collateral, assuming stability during periods of financial stress. When bond prices weaken alongside rising commodity volatility, collateral values decline at the worst possible moment. This creates a double squeeze, where liabilities grow while usable collateral shrinks simultaneously. To cover losses, institutions are forced to sell liquid assets regardless of long-term fundamentals. Equity markets, cryptocurrencies, and other assets may fall simply because cash must be raised urgently. This contagion effect transforms a silver squeeze into a broader macroeconomic event. Liquidity is drained from unrelated markets to fill the growing void in precious metals exposure. Regulators attempt to isolate the damage, hoping to prevent a full-scale financial seizure. However, modern markets are deeply interconnected, making isolation increasingly difficult. Attempts to control paper trading cannot suppress demand for physical silver. Physical markets respond independently, guided by supply shortages rather than financial rules. When paper prices are capped, physical premiums rise sharply to reflect real scarcity. This divergence encourages metal to flow toward markets offering true price discovery. Arbitrage accelerates inventory drain from regions enforcing artificial price controls. Every intervention designed to suppress volatility increases pressure elsewhere. The system becomes trapped, unable to stabilize without worsening long-term consequences. Participants begin to realize that paper prices no longer represent physical reality. Confidence shifts from financial instruments toward tangible assets. At this stage, market psychology changes permanently. As confidence erodes, attention turns toward psychological tactics used to influence market behavior during periods of extreme stress. Coordinated narratives often appear in media channels shortly before markets reopen. Headlines emphasize stability, liquidity assurances, and warnings of speculative excess. These messages are designed to calm the public while discouraging aggressive buying. Fear-based narratives aim to shake weak hands into selling at the open. Institutions require retail liquidity to unwind positions without triggering further price spikes. However, repeated interventions have reduced public trust in official messaging. Investors increasingly rely on price action rather than commentary. When price contradicts narrative, confidence in authorities deteriorates rapidly. Silver's continued strength undermines attempts to manage perception. As faith in guidance fades, behavior becomes driven by self-preservation. Individuals seek assets that cannot be diluted or altered by policy. This transition marks a shift from speculation toward wealth protection. Once this mindset takes hold, selling pressure diminishes significantly. Volatility increases as participants refuse to provide liquidity. Markets begin reacting to absence of sellers rather than surge of buyers. This imbalance creates rapid upward price movement. Each failed attempt to suppress prices reinforces conviction among holders. Psychological control becomes ineffective once belief is lost. At this stage, momentum feeds itself independent of news. As momentum builds, attention shifts toward the physical silver market, where supply constraints operate independently of financial engineering. Physical silver cannot be created by policy decisions or digital balance sheet entries. Mining output responds slowly to price signals, constrained by geology, regulation, and capital intensity. When demand accelerates faster than production, shortages emerge regardless of paper market signals. Physical dealers respond to uncertainty by widening premiums and protecting limited inventory. In extreme volatility, some dealers temporarily suspend sales to manage risk. This behavior further disconnects physical prices from futures quotations. Buyers begin referencing availability rather than quoted spot prices. Regional price differences emerge as metal flows toward markets offering higher realized value. Arbitrage drains vault inventories from suppressed pricing centers. Once inventories thin, replenishment becomes increasingly difficult. Industrial users compete directly with investors for remaining supply. Unlike speculators, industrial buyers purchase silver regardless of short-term price movements. Their demand creates a structural floor under the market. As inventories shrink, delivery timelines extend, and contract terms tighten, confidence in paper settlement weakens as physical fulfillment becomes uncertain. This shift accelerates preference for possession over promises. Markets transition from liquidity-driven pricing to scarcity-driven pricing. At this point, volatility reflects physical constraints rather than sentiment. Silver begins trading as a strategic resource instead of a financial instrument. As silver becomes strategic, governments and central banks begin watching price behavior with increasing concern. Rapid appreciation in a critical industrial metal raises alarms far beyond financial markets. Policymakers worry about supply, security, inflation, transmission, and geopolitical leverage. History shows that when commodities reach this stage, political responses soon follow. Export restrictions, windfall taxes, and strategic stockpiling become active considerations. Resource-rich nations recognize silver's rising value as a bargaining tool. Any hint of supply interference can send prices sharply higher overnight. Markets begin pricing political risk alongside physical scarcity. This adds a new premium layer that financial models struggle to quantify. Central banks face a dilemma because intervention risks accelerating the move. Liquidity injections intended to stabilize markets weaken currency purchasing power. Weaker currencies further support hard asset prices. This creates a feedback loop difficult to exit without long-term consequences. As trust in currency stability erodes, demand for tangible assets intensifies. Silver benefits from its dual role as money and industrial input. Investors increasingly view it as insurance rather than speculation. At this stage, volatility becomes a feature, not a flaw. Long-term holders grow more resolute as price swings validate scarcity. Attempts to restore calm through rhetoric lose effectiveness. The market transitions from disbelief to reluctant acceptance. With acceptance comes a final shift. As markets stop questioning whether silver should rise and focus instead on how far, price targets emerge as psychological milestones rather than resistance levels. Momentum traders join long-term holders, accelerating upward movement. Each new high attracts attention from previously disengaged participants. Media coverage shifts from skepticism to inevitability. Retail demand grows as accessibility becomes the primary constraint. Mining equities absorb excess demand when physical supply is unavailable. Capital flows into development projects and future production. This investment cycle plants the seeds for eventual supply response. However, production expansion requires years, not months. In the meantime, scarcity dominates pricing behavior. Volatility remains elevated as markets search for equilibrium. Long-term valuation frameworks replace short-term trading strategies. Silver reasserts its role as a benchmark for monetary stress. The transition reshapes portfolio construction across asset classes. Risk management shifts toward resilience rather than optimization. What began as a price spike evolves into a structural repricing. The market enters a new era defined by tangible value. Confidence slowly rebuilds around assets grounded in reality. Silver stands as a lasting symbol of the shift from leverage to scarcity.